So in today's video, I thought it'd be a really fun experiment to see what ChatGPT has to say about my two portfolios, about my Roth IRA and my simple IRA. So for the Roth IRA, it says, all right, this is actually a solid Roth IRA overall. Not perfect, but definitely not bad. I'll break it down honestly so you can see what's working and what could be sharper. Big picture. So the total value is 12.6. Overall gain positive across almost everything. Structure 64% mutual funds, 31% ETFs, 5% individual stocks. Translation, you're heavily invested in diversified funds, which is generally good. Alright, so let's see what this AI has to say. Well, you're doing well. You're heavily in the S&P 500. This is good. Your biggest holding, S&P 500 index, 60% of your portfolio. That's basically betting on the US economy long term historically. That's one of the most reliable strategies. Low cost index investing. Most of your funds, Schwab plus iShares, are broad market, low fees passive. That's exactly how long term wealth is usually built. Thank you very much. You're diversified with a kind of parentheses. You have exposure to US large cap, dividends, international, emerging markets, bonds. That's a complete portfolio, which a lot of people never reach, where things get messy. All right, here's where I'm going to push back a little. That's good, AI. Do your thing. Do your thing. You're overlapping a lot. You own multiple funds that basically hold the same companies. Example, FWPPSX, S&P 500, SCHX, US large cap, SWLGX, large cap growth. These all heavily overlap. Alright, problem. You think you're diversified, but you're actually doubling, tripling the same exposure. Okay. I'm not gonna complain about that. Too much dividend focus for a Roth IRA. You have SCHD 22%, DGRO 7.7%, O, which is royalty income plus Coca-Cola, dividend stocks. That's a lot of dividend emphasis. Issue: Roth IRA equals tax-free growth. Dividends matter less here than growth. You're leaning slightly conservative when you could be more aggressive. 3. Individual stocks at risk without much benefit. You own Coca-Cola, royalty income. They're fine companies, but they don't outperform your index funds consistently. They add concentration risk. They're not bad, just unnecessary. 4. Bonds might be premature, depending on age. If you're in your 20s to 30s, the bonds are likely holding back growth. If you're older, then it's reasonable. Yeah, I might need to check up on bonds. Performance reality check. All right. Damn, that's all right. Most funds up to 6 to 16% normal healthy returns. The S&P 500 is doing the heavy lifting, which I agree. That's exactly what we'd expect. So the overall rating, the ChatGPT gives me an overall rating of structure 7.5 out of 10, efficiency 6.5 out of 10, long-term potential 8 out of 10. All right, the efficiency part is what troubles me, and the structure. You're doing well, but you're overcomplicating something that works best simple. So what I'd improve, if I were cleaning this up, option A, simplify aggressively. You could honestly run 80 to 90% SWPPX and 10 to 20% SWISX International, and outperform most investors long term. Option B, keep your style but tighten it. Reduce overlap, pick either SWPPSX, FWPPX or SCHX, not both. Trim dividend ETFs slightly. Yeah, that's gonna be tough. Decide if you actually want bonds yet. The key insight. Right now, your portfolio feels like I bought a little of everything to be safe. What you want is I own a few strong things with purpose. Bottom line. Bottom line, you're not doing anything wrong. You're already ahead of most people, but you're a bit cluttered and slightly too conservative. What? You serious? If you want, I can suggest an exact percentage allocation tailored to your age. Okay, yeah. So I just typed in 23 current age, and it hits me with it. At 23, I'm going to be very direct with you. You're investing well, but you're playing it a bit too safe and a bit too complicated for your age. You've got your biggest advantage right now, time. That means your portfolio should be tilted heavily toward growth, not income or stability. When your age changes. At 23, your priority should be maximize long-term growth, ignore short-term volatility, keep things simple and scalable. You don't need heavy dividends, much in bonds, a bunch of overlapping funds. Okay, it's not bad. I mean, it's giving me pretty good feedback. Yeah, it's not bad for ChatGPT reviewing my portfolio. Biggest misses for your age. Too much dividend focus, SCHD and DGRO plus Coca-Cola and realty income. These are stable, income focused, slower growth. At 23, you want growth and income. Bonds are holding you back. At your age, this is almost certainly unnecessary unless you panic during market drops or want stability. Panic? Hell no. That's disrespectful. I'm selling that shit tomorrow, bruv. After what it just said, panic during market drops. I'm selling my bonds tomorrow morning, man. I'm giving a sell order. That's disrespect from ChatGPT. Alright, I'm selling my shit tomorrow, bruv. Too many overlapping funds. You've got F. Okay, yes, that is true. What you should look like. What you should look like at 23. Option 1, 80 to 90% into the S&P 500 and 10 to 20% into international. That's it. This will outperform most portfolios long term with minimum effort. Or option 2, slightly more aggressive, 70% into the S&P 500, 20% into the SWLGX, which is just pure growth tilt, and 10% Swiss international. Optional, small SCHD position if you really like dividends. And the feedback, what I'd reduce or remove. If you want to optimize, trim or remove. SCHX, redundant, alright, I agree with that. DGRO overlaps SCHD. Although I might agree, but I don't think I'm gonna sell any shares of DGRO or SCHD. I'm sorry, ChatGPT. Swag bonds. Yeah, I'm selling that after what it just told me that I panicked during market drops. Hell no, I'm selling my shit tomorrow. Consider shrinking. SCHD 22%, maybe 10% or less. I can't do that, buddy. I like my nest egg of SCHD. I won't increase it or decrease it. I'm just gonna leave it like that and just allocate more into the S&P 500. I think that's the game plan. But ChatGPT is giving me pretty good feedback. I mean, it's not bad. Individual stocks, fine to keep small, 5 to 10%, but not necessary. All right, the real upgrade. You don't need a better portfolio. You need a simpler one with higher growth focus. All right, which is not bad. So, ChatGPT reviewing this portfolio was pretty good and pretty helpful, honestly. I thought the portfolio was doing all right until ChatGPT told me that I'm overlapping too much. So it was a pretty good insight into my portfolio about what I'm overcomplicating something that should be more um, sim simple. So I'm gonna be reviewing and taking um, changes into my portfolio, maybe reducing some positions for sure. Bonds, I don't want that anywhere near my portfolio after it just told me that I panicked during market drops. But yeah, not bad. I mean, how many other people do this stuff? Do they input their portfolio and see what ChatGPT tells them about it? But I thought it was a good experiment. I thought it was a good experiment to see what AI or ChatGPT would say about my portfolio. If you enjoyed the video, make sure to like, comment, and subscribe.